Welcome to Smart Project Concepts. We finally made it. What I call Smart Project Concepts is this is a university grade education in Forex. What you're going to see, there's going to be a bunch of webinars, bunch of videos down below. All these videos, they are recorded in a virtual class setting. It's like I'm here in the classroom and you're on the other end watching how we present things, present simple concepts on the whiteboard in a virtual class setting. Now, I know a lot of you members are older members of Market Fluidity and you're just getting into Smart Project Concepts watching this. There's nothing new. Some concepts are newer, but some concepts are even more broken down for a better understanding. For people who are new, I welcome you all to the best education in Forex when it comes towards simplicity. As new traders, there are a couple of things that happen, right? Psychologically, things go wrong. Mentally, things go wrong. You go into over trading, over risking. But once you truly understand what price is really doing, where market is really moving, how candles are really printing, all these things go away, which is why there are a couple things that we really focused on a lot in Market Fluidity and now coming into Smart Project Concepts. Risk management. Managing risk, keeping your losses small and making sure your winners comparatively to your losses, they seem bigger. Adding risk back to the trade. Let's say you manage the risk. Giving your trades a second chance by keeping the same bias. Adding positions back to a winning trade. All these things, they go hand in hand. And technically, if you really truly understand how price is moving, why is it moving, when there's volume, when there's not volume, psychologically, your whole perception about trading gets better. So take it slow. There's a lot of information. There's a lot of knowledge in this section and the Market Fluidity section. So what I'm going to say is if you are new, if you've maybe been in the Forex market for about a month or 2 months, I would highly recommend to go through the unlearn and relearn section in Market Fluidity. Then come into Smart Project Concepts. In future, obviously we have Slack, our community, and also at the same time, now we're going to be not doing any more webinars. Of course, there's going to be simulation webinars every bi-weekly, but mostly what we're going to focus on are going to be virtual classes, like different topics that we can go over in a virtual class setting. So what you're going to see in the future now is this list. It's going to continue to grow and grow and grow because I think having a virtual class setting is the best form of learning. To be honest, I learned that way much more better than just a webinar. So again, congratulations. You've enrolled into one of the best education platforms on the internet right now about Forex. So take it slow, give it time. Don't expect results in the next month, 2 months, 3 months. Give it at least 6 months to a year, following these concepts slowly and gradually, building a trading plan, refining your trading plan, and you're going to see a light at the end. This has happened to a lot of people. This is still happening to a lot of people, and a lot of new people are going to see that light, are going to see that light of profitability. That's what I call it, right? It's going to happen. So if you think it's not happening for you now, you just got to dial down on your risk, on your trading plan, on the time that you're going to trade, how you're going to focus on all that stuff. So it's game time. Good luck and take care. What's up, everybody? Welcome. Now today, this is going to be the most important section, right? So we're going to talk about risk management. Now, a lot of you people, a lot of you guys already know about risk management. A lot of you guys already know how to manage risk, what sort of risk you're going to use, what sort of, like, if that's going to be, you're going to use a static risk, dynamic risk, where you're going to put your stop loss and stuff like that. So we're going to go over all of that. Now, before we start, this section is going to be divided into 3 parts. The first part is going to be about different types of risk or different types of stop losses that you want to use. The first one is always going to be the static risk. The second one is going to be the dynamic risk, right? So these are very important, static risk and dynamic risk. Now, the second part is going to be about where exactly to put your stop losses and how you can use static risk and dynamic risk in actually putting your stop losses, right? So let's say you're going to have a stop loss, and now you have to identify whether you're going to use a static risk or a dynamic risk. Now, before we begin, dynamic risk is a little bit complicated. It needs a little bit of a practice and a little bit of intuition trading. Intuition trading is basically when you're anticipating a certain move, or you're anticipating certain, a retracement or liquidity grab. So that's where you're using dynamic risk. So we're going to go over that too. Now, the third part is going to be the most important part. The third part is going to be how to reduce your losses, right? This is the only way that you can come out of that break-even stage, because a lot of people get stuck in the break-even stage, and the only way to get out of that break-even stage is to understand how to reduce your losses. So we're going to go over all of that. Let's get into it. Okay, first we're going to talk about static risk. Now, whenever we're talking about risk, we are basically talking about risk in terms of 1% to 2% risk, right? So static risk is going to be, so let's say we donate static risk with SR. Static risk is, let's say if you're a trader and you're trading and you identify an opportunity, you're going to use, let's say, 1% risk. That's about it. That's the only thing you're going to use, 1% risk. That's it. Now, next is, let's say you have a $1,000 account, you have $1,000 account, and you want to risk 1%. Now, what's 1% of $1,000? That's around $10, right? So that's around $10. So you're going to risk $10 in the anticipation that a trade goes your way. Very, very basic stuff. Nothing complicated, nothing really advanced at this point right here. Simple. You got $1,000. You're risking 1%, and your risk is going to be total $10. Now, let's say if you're risking 2%, you're risking 2%. So your risk right here is going to be around $20, right? Now, what does this relate to in lot size? Now, listen, how to calculate lot sizes, how to calculate your risk and pips in terms of lot sizes, it's already explained in our risk management section in market fluidity, right? So go over that. This one right here, we're going to keep it very simple, and we're going to go over dynamic risk. Now, static risk, let's say you have a candle, and the candle is pushing bullish at this point, and let's say we're at support, and you want to take a buy at this point, right? So if you take a buy, you can take a buy right over here. You got your little buy over here, and next candle goes up. Your total risk at this point was, let's say, 1%, right? So you took one position. Let's say this position could be, 10-cent lot. This position could be $1 lot. This position could be, let's say, your 4 lots here as well. So you just took one position, price went in profits. The price would have came down, it would have hit your stop loss, and you would have lost exactly how much you would have risked, right? So that's static risk. Very, very simple, nothing complicated, very, very basic stuff. Now, I know a lot of you people have some questions. We're going to keep those questions to ourselves, because as we go along, all those questions are going to be answered. Now, next we're going to talk about is going to be dynamic risk. Now, dynamic risk is where things get a little bit complicated, a little bit advanced, but not so advanced, right? So let's talk about this right here. Now, dynamic risk, we're going to denote this by DR, okay? Now, let's say you're a trader and you're very disciplined. You don't want to risk a whole lot of money at this point. You're very, very risk averse at this point. So let's say you're going to go with the total risk that you're going to use is going to be 1%, right? Let's say your total risk is going to be 1%. If your total risk is 1% and you don't want to execute this whole 1%, it's always a good idea to break this down into 2 positions, 3 positions, 4 positions, right? So sometimes what guys do is they'll break this down to 0.5% risk, 0.5 and 0.5, right? Now you got your 2 positions. One position you can enter first, second position you can enter later. Now, sometimes when you enter the first position and now you want to wait to enter the second position, price may already move. When price already moves, you're only stuck with just one position and you had no opportunity to add that next position. Now, that has sometimes happened to me as well, right? If I would say a price has to go down, and I would take a sell, and then I would say that I'm going to enter another sell as price retraces. Instead of retracing, prices continues moving, and I'm just left with just one position. That's very, very normal. That comes with using dynamic risk. Now, for example, let's say we have a 2 lot, right? Let's say your total risk, based on your stop loss, based on your the amount that you're willing to risk, you're going to use 2 lots at this point. Now, instead of using 2 lots, I think it's going to be a good idea to maybe break this down into 2 1 lots. Wouldn't that make sense? Like if you're on a setup which you're not unsure about or which you're not sure about, you may want to break down your 2 lot into 2 1 lots. Or sometimes, we get a setup which is risky. Let's say if you're not that confident in a setup, and you may want to break this down into 4 positions, and that may be 4, 0.5 lots. You have 0.5 and you have 0.5. You have 4 0.5 lots. You may break down positions in 4 0.5 lots, and that's what's going to constitute dynamic risk. Now, to break it all down, static risk is where you are using your complete risk, right? And always remember, whenever you're using static risk, you have to manage risk. So we're going to talk about managing risk in the third section of this virtual class. You have to manage risk if you're using static risk. If you're using dynamic risk, you're basically managing risk even before when you're taking the trade, right? So that's the difference. Dynamic risk is where you break down your full risk into multiple positions. Static risk is where you're using the entire one risk. Let's say this is 1%. Static risk is where you're using your complete 1%. Okay? Very basic stuff, nothing complicated. Let's move over to part 2, which is going to be applying static and dynamic risk based on candle conformations. All right. Let's say we have a trend that's coming down. We're going to come up, create resistance. Come down, we're going to come up, create resistance, and come down, right? So we have a trend that's moving down, so we have a bearish trend at this point. So whenever we have bearish trend, what are we looking at this point? We're looking at resistances to form, because once we see a resistance forming, then we can identify that, okay, since we have a resistance forming, there's a very high probability that price can continue pushing down, right? So let's say we have a bullish candle at this point, and then boom, we have a resistance formed. Now we have a resistance formed. Now let's suppose this is a 30-minute time frame or a 1-hour time frame. 15-minute may be a little bit tricky, because as we all know, the 15-minute time frame conformations are weak conformations. 30-minute and 1 hour are strong conformations. So let's say, price was coming down, we made support, came up, and now we're creating resistance to possibly continue pushing down. Now, in this case, let's say you're looking at this, you got all the confirmations, and let's say you also have this range, and this is a 35 pip range, and you're like, okay, you know what, I can probably take a sell over here, and I can have a very, very good trade at this point. And you're going to say, okay, you know what, I'm going to take a sell right here. So you're going to take a sell, and this is going to be static risk. So if you're using static risk, you're maybe using your full 1% trade, or you may be using your full 2% trade, and you're taking a sell, and your stop is obviously above the candle, right? Your stop loss is always above the previous candle. You're taking a sell, and you're anticipating price to go down with your full 2% risk. Price goes down, you make some profits, you close the trade, you're like, perfect, I use static risk, and price went in my favor. Now, remember this. This is very, very, very important. Whenever you're trying to use stop losses, your stops always have to go above the previous candle if you're taking a sell, and it has to go below the previous candle if you're taking a buy. So it's not about how big your stop loss is, it's not about where your stop loss is, it's all about where your stop loss is, not about how big your stop loss is. Like sometimes what guys do is like, you're going to trade gold or you're going to trade pound yen, and you're going to turn around and say, oh man, you know what, I have a very aggressive stop loss, that's just not going to fly over here. Right? If you're looking at 30-minute time frame, you're looking at a 1-hour time frame, you have to make sure your stops are above the previous candle if you're taking a sell, and your stops are below the previous candle if you're taking a buy. Because take a look at this. If this candle has to go down, it has to respect the high of the previous candle, and that's where your stop is going to go. It has to respect the high. I can't stress this enough. It has to respect the high of the previous candle if it has to go down. So that's where your stop is going to go. If for some reason price does not go down, and price, let's say, starts to move up from this point, what are you going to lose, right? If we break above this high, what are you going to lose? How much percentage is it that you're going to lose? You're going to lose 2%, because you have static risk, right? You have static risk, so you're going to lose 2% of whatever you risked, okay? That's static risk. Now, let's talk about dynamic risk, which is very important here. And usually I use dynamic risk when, like, you know, when I'm not too sure about certain moves, so I'm going to use dynamic risk. Static risk, most times I use static risk because I can manage risk. And we're going to talk about managing risk in the third section on static risk. So now dynamic risk. Dynamic risk, let's say you have, or you want to risk 2%. You're risking 2% and you're going to say, okay, you know what I'm going to do? I'm going to break this 2%, my risk, down into two positions. So you're going to break this down into 1% and 1%. That's what you're going to do. You're going to break this down into 1%, 1%, and now you have two positions. The first position, you're going to say, okay, you know what? I'm going to take the first position. Now, these are all hypothetical situations, right? Candle can move up to make a wick, or candle can move down, right? So what happens in this point is that you're taking a sell as soon as the candle starts. So this is where your first position goes, 1%. You're using dynamic risk. Now, if price goes up, this is where your stop loss. Now, if price hits your stop, how much are you losing at this point? Out of your 2%, you're losing 1%, okay? Because maybe you're not sure about this position, you're a new trader, this is a setup that you've been watching for a long time and you're executing on this for the first time, so you're being very cautious of the risk you're taking. So if price hits your stop, you're losing 1%. Now, there are different variations. Sometimes what guys tend to do is that as price retraces, they will add another position, and this is going to be another 1%. They're going to add a position, right? And the stop is going to be at the exact same place. Now, what's the difference between the first position stop loss and the second position stop loss? The first position stop loss is wider, right? The second position stop loss is smaller at this point, but now you have an opportunity to get a better price for this potential sell, right? Now, let's say price goes up, it does not break the high, it respects the high and starts to go down. Now you're in the money. At this point, you're in the money. How many people have, like, you know, executed on candles that have been moving up, and you're anticipating the candle to make a top wick? And you're anticipating the candle to make a top wick, and the price starts to go down in your favor, you're like, oh yeah, isn't that a great feeling? When price starts to go in your favor at this point, without breaking the high, so we respect the high, you took your second entry right here, price move in profits, and you're like, okay, you know what, perfect, I won the trade, awesome, right? Now, the second scenario here, second scenario that happens at this point is going to be, let's say you have taken a sell, right? And this sell is the dynamic risk that you've taken just as soon as this candle opens, so you took 1%. Now, price retraced, right? Price retraced, and you're like, okay, you know what? Price is retracing. I don't want to enter a position as price is retracing because I find it very, very risky, because if I enter a position and price hits my stop loss, I'm going to lose 2%. So if it hits my stop loss, I'm okay with losing 1%. The number one rule of managing risk is to always be okay with how much you're going to lose. That's the number one rule. Write it down. I'm going to wait. Write it down. Always be okay with how much you are going to lose. Accept that fate that you're going to lose that much, right? So if price retraces, it's going to hit your stop, you're going to lose 1%, so you're not going to enter a second position. What you're going to do is, what I like to do most times is that if I'm going to go for a dynamic risk, as price starts to come back down and start to form bearish, I'm going to enter another position right over here. My second 1%. Because what I'm doing is I'm anticipating that if a candle has a top wick and a bottom wick, right? If a candle has a top wick and a bottom wick, and if price is breaking its own low and trying to go bearish, I'm anticipating that, okay, maybe the candle has made that liquidity wick. Now, some questions may happen that, oh, you know, should this happen in the first minute or the first 2 minutes or the first 3 minutes, 5 minutes? That's besides the point. We're not going to talk about that. When a candle moves in the first minute, 2 minutes, that's basically how many times have you seen that happen. That comes with experience. It comes with intuition, you know, whether you're going to enter in the first minute, 2 minutes, 3 minutes. Over here, we're only going to talk about very simple stuff, and that simple stuff is going to be, let's say, for example, that the first half of this candle made the top wick, right? And if it starts to go down in the second half, now I'm anticipating that, okay, maybe the first half made a top wick, and now in the second half, we're trying to go down, and that's where I'm going to enter the second position. Right now, if let's say that I want some extra confirmation, maybe this is what I'm going to do. And this is what I usually do as well. If I want some extra confirmation, and some of you already have that answer in your mind, it's going to be once this candle starts to break the low of this previous candle, second position will go right over here. And guess where the stop is going to go? The stop is not going to go above the previous candle. The stop is going to go above this current candle. And then you can trail your previous stop above this current candle as well. Because guess what? If we're breaking the low, then there's no reason for price to come up and break its own high. Because if price is making a lower high, which is lower than the previous candle, and it's breaking the low to make a lower low, where are we going? We're going down. Okay? So that's what I'm doing. Dynamic risk. We talked about two situations, dynamic risk. First, you enter at this point. Second, you enter as price retraces, but that depends on confidence. The second one, you enter as we try to go bearish, or, sorry, we talked about 3-1, or you enter once we break the low. I find in dynamic risk, what's more useful is that you enter when the candle starts, and then you know, the second position, if you really want to take a second position, you take that position as the candle breaks the low of the previous candle. That's what you do. That's what I've seen that has worked for me as well. And I've seen, like, you know, a lot of people have done that as well in our group, Slack group, YouTube, whatever. Now, let's say you're entering your 1% at this point. First position goes right here. And now you're going to say, okay, you know what, I'm going to enter the second position as price retraces, but instead of retracing, we create a tiny wick, and then price starts to break the low. In the first minute, or 2 minutes, 3 minutes, whatever, price starts to break the low, and you're like, oh, we're breaking the low. I don't know if it's breaking the low to retrace up. If it retraces up, that's a whole other thing, right? So we're not going to discuss that. If price breaks the low and starts to go down, now you only have 1% running, and you're like, oh, okay, you know what? I had no chance to enter the second position. Now, that has happened to me a lot sometimes too, where I basically had no chance of where to enter the second position. You know, so you got to take it how market gives it to you. That's the bottom line, right? Now, for example, instead of using two positions, you're going to say, okay, you know what? I'm going to be a little bit more risk averse. And what I'm going to do is, I'm going to break this down into 4 0.5 lots, right? 1, 2, 3, 4. I'm going to break this down into 4 0.5 lots, right? So you can basically do the same thing. You can enter the first one right here, 0.5 lot, price retraces. There goes the second one, 0.5 lot. Your stops are right up over here above the previous candle. If candle retraces further more, you're going to lose 1%. You know, you're not losing much. You're just getting better prices, right? If price starts to break the low of the previous candle, there we go. You can enter another 0.5, or you can enter 2 0.5s, or you can enter, you know, a full 1%, making your total risk up to 2%. Go over the section again, right? Making your risk up to total 1%. So there are different variations how you can use your dynamic risk. And dynamic risk is very, very, very powerful because, you know, it teaches you the idea of managing risk. It teaches you the idea of how to average in positions as price goes in your profits or price goes in your direction as it's moving. And the same thing applies for if it's the opposite way, right? If price is moving bullish at this point. But always remember, as we talked about in some sections, that when you're trying to sell resistance, you're only selling resistance when we are in a downtrend. And you're only buying support if we are in an uptrend. Very, very important concepts, right? Very important concepts. Now, the third part, most important part, how to manage risk. How to make sure that you lose less than what you anticipated to lose. This has kept me out of trouble so many times. Like a lot of people, they see the streams, they see the history, they see the results, and they're like, man, how can you lose so less? How are you able to lose so less? And let me tell you this right now. It's not all the time you're going to be able to manage risk. It's not all the time that you're going to be able to close 50% or close 60% or close partials as candle highs get broken or the lows get broken. It's not going to happen all the time. There's a probability. Sometimes as price goes against you, you will lose the entire percentage, right? But most times you're going to have opportunities to manage risk. Sometimes you're not going to have opportunities, and that's just the odds of trading, right? But most times, I stress this again, most times you will have an opportunity to cut your losses short. So together, let's take a look at this right here. Now, let's say, for example, price is at a support, right? Price is at a support and we're going bullish. We're in an uptrend, and price, if it wants to go up, it needs to create a support. And you're looking at, the high created up over here, and this candle, basically, we came down, and you're looking at a support to be formed, and boom, you have a support formed. This is your high at this point, and let's say that this range is about 40 pips, because this is a pound yen or gold or whatever pair this is, right? You have 40 pip range, trend is up, and we've created a support. Now, we've created a support. Now, let's say this is a 30-minute time frame, so we're going to mark this down right here, right? So this is a 30-minute time frame, and now you're saying that, okay, there's a high probability for the next 30-minute candle to continue pushing up. So what are you going to do, right? Let's say, for example, that we're going to use static risk. Managing risk is always good when you're using static risk. When you're using dynamic risk, your risk is already managed. There's no, further managing risk on a dynamic risk. You're basically over managing risk. And trust me, that's a term. When you over manage risk, that's a term. Like a lot of you guys were watching this again from Market Fluidity. I understand that some people over managed risk, and that's not good. Don't over manage risk, right? Only do it once or twice. So let's say static risk. So you're going to say, okay, you know what? I'm going to enter a buy right over here, right? You're going to enter a buy. And this is going to be, let's say, 1%. You're risking a total of 1%, and you're going to take a buy at this point. And obviously, your stop is below the previous 30-minute candle. And now you're anticipating this candle to respect this low and then to continue pushing up. If it continues to push up with respecting the previous low, awesome. You got a winning trade, you got full 1%. Now, let's say, for example, now we're going to break down this 30-minute into 15-minute candles. Let me do this. So let's do this. I'm trying to see where we have clean area. Okay, let's do this right here. So let's say, for example, that this 30-minute candle represents two 15-minute candles that look like this, right? You got two 15-minute candles. Oh, made a mess about it. So you got two 15-minute candles that look like this, okay? Now, you have the new 30-minute candle starting now, which means that you're trying to take a buy on the next 15-minute candle. So you take a buy right over here, and that denotes a 30-minute candle right over here. You've taken a buy, and this is where the candle starts. Now, if this 30-minute candle respects the previous 30-minute candle's low, your trade is still valid, and then, price can go up. What this means for the 15-minute candle is that if this 15-minute candle starts to go bearish and it closes bearish, now there are two variations, right? Remember, if it closes bearish, you have to close 50%. So from here, we're going to close 50% of the trade. If you had let's say a 1 lot running, you're going to close 0.5 lot. If a 15-minute candle closes bearish, and I'm going to tell you why. The reason why is that if the 15-minute candle has closed bearish, then there's a probability maybe the next 15-minute candle can continue to go down. And if the next 15-minute candle continues to go down without you closing 50%, now you're going to lose your entire position. Okay? Because if price has to go down, you have to remember, don't let your complete position go in a drawdown. The idea of managing risk is to never let your full position hit a stop loss. That's the whole idea. So the first variation is when the 15-minute candle is closing bearish, boom, 50% off the table. No matter what, 50% off the table when a 15-minute candle closes bearish. Now, if, let's say, for example, the 15-minute candle does not close bearish, and if the 15-minute candle breaks the low, right, let's say that this candle is still open, breaks the low of the previous candle, this one, boom, 50% off the table, 100%. Because if it's breaking the low and respecting the high, what are we doing? We're making a short downtrend at this point, right? If the 15-minute candle respects the high and breaks this low, 50% off the table, 100%. You're taking 50% off the table. You're not giving market a chance to take your complete stop out. That's the deal right here. Because if it has to go up, it has to respect the dynamics on the smaller time frame as well for buys, right? If it has to go up, the 15-minute candle has to respect this low and then continue to push up, and overall making the 30-minute candle go up as well. It has to respect the low. 100%. It has to respect the low. Now, there's a question that may be coming up, and that question would be, oh, but what if a 15-minute candle closes bearish, okay, and we close 50%, and obviously this first 15-minute candle is the half of the 30-minute candle, right? What if the second 15-minute candle starts to go up and then continues to go up on the second one? Then what are you going to do? Well, in that case, you're going to be using the concepts we talked about in how to give your trade a second chance. Or you're going to use the concept we talked about, adding positions to a winning trade. Now, if it does start to go up, that means that maybe the first half of the 30-minute candle wicked down and the second half started to go up. But honestly, I've seen this happen very rarely, very rarely that we've had a bearish 15-minute candle and then the next one has gone up. It does happen very, very rarely, but it does happen, but also at the same time, it's also very important to be risk averse, right? You have to mitigate risk. It's very, very, very important. So whenever I'm using static risk and I'm looking at the 30-minute time frames, if the 15-minute candles break the previous low, I'm taking 50% off the table. Right? If I'm taking a sell on the 30-minute time frame and the 15-minute candles are breaking the high of the previous 15-minute candle, I'm taking 50% off the table. If we do continue to go in our direction where we thought price was going to go, then either I'm going to let whatever's left is run, or if there's an opportunity, I'm going to add that risk back to the trade. And that's what we've talked about in another section here as well that you can look into. Okay, when we're using dynamic risk, there's basically when you're using dynamic risk, you can't really manage risk because from the get-go, you've already managed risk on that dynamic risk. Because if you're using, let's say, total 1 lots right here, so dynamic risk would basically mean that let's say you're breaking this down into one 0.5 and another 0.5, right? So you're taking 0.5 right here, and you're taking 0.5 right here as the new 15-minute candle is forming. That's basically managed risk there anyway, because your total risk is 1 lot, and you have a 0.5 open, and you're basically entering the second position based on what we talked about earlier, right? So dynamic risk is perfectly fine. Whenever you're using static risk, that's when you're managing risk. Right, now, risk management, It takes practice. It takes time. Don't assume that you're going to get really good at managing risks. It's going to take time. It's going to take time to accept losses. The biggest problem people have is to really accept your losses. If you're not going to be able to accept your losses, you're going to overtrade, you're going to over-risk, and you're just going to compound your losses. Man, trust me, if you have a solid trading plan, right, and your trading plan says that you're only going to risk 2% or 1%, and you're going to manage risk on those trades, your trading plan is going to be rock solid. Your trading is going to be amazing. You're going to have a higher confidence. Your ego is going to be up. You're going to be more confident in executing trades, knowing that you can manage risk. And also another thing, right? And this happens to all of us. Whenever we increase our lot sizes, guys say, oh, you know what, I'm super scared, I'm super anxious to increase the lot sizes. Raja, you have any tip? The biggest tip is this. Whenever you're increasing your lot sizes, just understand that you can manage risk. If you're going up from a 50-cent lot to a 1 lot, and you're kind of like scared at that point, just know this, that what's the worst that's going to happen on a 1 lot, right? If your stop is, let's say, 12 pips, for sake of simplicity, 12 pip stop loss, 1 lot, you may lose $120. But if you know how to manage risk, you may lose $80, right? You may lose $70. So that's a win in itself. If you're defeating your risk and you're losing less than what you planned on losing, that's perfect. And before we end this, understand this very, very carefully, right? In the start, it's very normal for you to focus on wins. It's very normal for you to focus on making the most amount of money, the biggest trades, and the best trades. That's perfectly fine. But what happens in the beginning? Everyone starts to lose money. So what are you going to do at this point if you start to lose money? Are you still going to focus on making great trades and great wins and lots of money, and you're going to keep overtrading, over-risking? No. The only thing you're going to do is to focus on how to stop the bleeding. And bleeding here means you losing money in the markets. You can't do that. That's the first thing you need to focus on. And honestly, in the beginning, when I first started, if someone would have told me, hey, Raja, listen, what you got to focus on first is how to manage risk. And what we did in the beginning was to how to make the most money, how to compound the most money, how to keep compounding and making these millions and gazillions, hundreds of thousands of dollars. No, it all came down to now. What I know now, if I knew this back then, my trading journey, very easy, very quick, very robust. Because in the beginning, we have to focus on manage risk. Take pride that you can manage risk. Whenever I lose a trade, I take pride in that, because my loss of a trade, it determines that, hey, you know what? I wanted to lose 2%, but I lost 1%, or I lost 1.5%. So in a way, that's also a win for me, right? Now, watch this virtual class again, and there's some things that you really have to incorporate in your trading. If you don't incorporate these techniques in trading, these even psychological techniques, that it's okay to lose, but lose less, aim to lose less, even ending the day with losing less than you planned is a winning day in itself, trading will be very easy for you, very simple. There are a lot of people in our groups here that do the same. They lose less, they have a strong command on their risk management that they can lose less. And that's where you win more. Because at the end of the day, you cannot control the amount of money you're going to win. Because price is just going to go where it wants to go. You can't control that. But what you can control is what you're going to lose in the markets. Take care. How's it going, everybody? So in this section, we're going to talk about how different sessions, they influence different time frames. Now, before we get into the depth of that, we have to understand this one thing. When do we have big candles forming, right? What are the times when we have big candles forming? Because as we've discussed before, the bigger candles are only going to form when there's going to be volume in the market. Let it be the 4-hour candle, the 1-hour candle, 30-minute candle, 15-minute candle, whatever candles there are, right? The bigger candles are only going to form when you have volume in the market. We have to understand this one thing. So now, what we're going to talk about is going to be the 4-hour candles, and we're also going to talk about which sessions influence the 4-hour candles, because the 4-hour candles obviously have to be bigger. And we've also talked about that whenever you're trying to take a trade, you have to make sure that a candle is going to be a bigger candle. If you're missing out on those trades, you have to understand that, okay, when did this big candle form? Did this big candle form because there was volume in the market? Did this big candle form because there was a market open, pre-market open? Was there any news events at that time? Was there any breaking news happening? Sometimes you're going to have bigger candles form when there's going to be no volume in the market, right? Before the market opens, before even the pre-markets open, that's going to happen. So once we get into this, you're going to understand that how sessions are going to influence your time frame. Then specifically, we're going to talk about the 4-hour time frames. Okay, to start this off, we know that there are 6 4-hour candles in one daily candle. So we're going to write them down right over here. So we have the first 4-hour candle, 1, 2, 3, 4, 5, and 6, right? So we have 6 4-hour candles, and these 6 4-hour candles, they make the overall daily candle, right? Now, whenever we're looking at the 4-hour candles, we understand that not all 6 4-hour candles are going to be bigger candles, because some 4-hour candles are going to be smaller, some 4-hour candles are going to be bigger, right? And we also understand that if we have one daily candle which looks like this, a bigger one, we understand that maybe there were only like 2 4-hour candles that made the daily candle bigger. Maybe there were 3 4-hour candles that made the daily candle bigger. So these things we have to understand. So we're going to talk about which sessions influence these 4-hour candles. Now, let's take a look at the first one. Now we need to understand when this first 4-hour candle starts. The first 4-hour candle normally starts at around 5 p.m. and goes till 9 p.m. Eastern time, right? We're only talking about Eastern time right here. The first 4-hour candle starts at 5 p.m., goes all the way up towards 9 p.m. Eastern time. Now, we have the second 4-hour candle. Now, once we're looking at the first one, which sessions fall in this first 4-hour candle? It's very simple. Which sessions fall in the first 4-hour candle? It's your pre-Asian and your Asian open. These are the 2 sessions that fall in the first 4-hour candle. Now, sometimes we do have the 4-hour candle, the first one, which is a bigger candle, right? That's when we can say, okay, what? Maybe in the Asian session, there was a lot of volume, and maybe that volume really pushed the 4-hour candle. Now, next one, next 4-hour candle, it starts at 9 p.m., goes all the way up towards 1 a.m. Eastern. What's this time? Do we normally have volume during this time right here? Do we have volume during this time? Probably not. We don't normally have volume at this time. So normally, most of the times when you take a look at your charts, you're going to understand that this 4-hour candle is mostly a small candle, right? A small candle because there's no volume at that time. The 1-hour time frames are consolidating. The 30-minute time frames are consolidating. That's why we always talk about that. Always make sure you're taking a trade when there's volume in the market, right? After this, we have the next 4-hour candle, and this 4-hour candle starts at 1 a.m., goes all the way up towards 5 a.m. Eastern. Now tell me which session falls in this 4-hour candle. You have your pre-London. So in this session right here, in this 4-hour candle, you have your pre-London and your London open. These are the 2 sessions that fall within this 4-hour candle. So normally when you're going to take a look at this 4-hour candle around this time, you're going to notice that this 4-hour candle is going to be a bigger candle. It's regardless the fact that maybe the 1-hour candle printed the 4-hour candle bigger, or one 30-minute candle made a 4-hour candle bigger. But the fact is that most of the time during this time right here, 1 a.m. and 5 a.m., you're going to see that the volume is going to be in this 4-hour candle. So the point is, when you're trying to make a trading plan, right? Whenever you're trying to make a trading plan, you have to choose that which time frame you're going to choose to trade. This is very, very, very important. The most important aspect. Next, we have from 5 a.m. We have 5 a.m. all the way into 9 a.m. Eastern. We have another 4-hour candle. Now you need to understand that which session falls within this 4-hour candle? And the answer is simple. You have your pre-New York and you have your New York open. You have two sessions, high volume sessions, but also don't forget that these two 4-hour candles are the most volatile 4-hour candles. The most amount of volume that's in the market lies between these two 4-hour candles. And sometimes, like, you know, there's a lot of volume in this 4-hour candle as well. So let's talk about that here first as well. So this 4-hour candle, we have 9 a.m. going all the way towards 1 p.m. Now, which sessions fall in this 4-hour candle? Let's talk about that. We have the NYSE open and we have London close in this 4-hour candle. Let's talk about the last one. This last 4-hour candle, we have from 1 p.m. all the way till 5 p.m. and normally there's not enough volume in this 4-hour candle. So because, you know, price is consolidating, London is closed, Asian is closed, we're coming up to a close of the New York session. So normally there's no volume and normally I don't see anyone trading at this time. So the only bigger volume time frames or the only bigger volume sessions we have, they lie between these three 4-hour candles. We have 1, 2, and 3. So whenever you're creating a trading plan, you have to understand that, okay, which 4-hour candle am I going to focus on? Am I going to focus on the third 4-hour candle, which is where you have your pre-London and London open? Am I going to focus on the fourth 4-hour candle or the fifth 4-hour candle? Because that's the idea, because you're only looking to trade when there's volume in the market. Because trust me, whenever you're focused on, because, okay, here's the thing. You're only trading one hour candle or one 30-minute candle. And we've talked about that in breaking down the higher time frames to the lower time frames. But right over here, we're only talking about how sessions are going to influence your 4-hour time frames, how sessions influence your time frames. So whenever I'm looking for a trade, I'm looking at where the next 4-hour candle is going to go. If I see that I have consolidation happening on the second 4-hour candle, I automatically understand that, okay, if we have consolidation happening on the second 4-hour candle, maybe the third 4-hour candle is going to be the move. Maybe the third 4-hour candle will move price where it has to go. So you have to visualize how the third 4-hour candle is going to form. And then you try to understand that, okay, you know what, the third 4-hour candle, it has my pre-London and my London open. So maybe there's going to be a lot of volume coming in from these time frames. So I have to be ready to anticipate where the 4-hour candle is going to go. If there's no volume during these times, then the 4-hour candle basically isn't that big of a candle. Then you're trying to see that, okay, we probably consolidated, or let's say we had volume during Asian 4-hour candle, and then we had no volume during this time. And then all of a sudden, the pre-London and London open 4-hour candle starts to consolidate right here. So maybe we're going to have volume in the fourth 4-hour candle, which falls in pre-New York and New York open, right? So whenever you're trying to see when you're going to trade, you're trying to anticipate where the 4-hour candle is going to go depending on which session you're looking at. So whenever you're trying to make a trading plan or whenever you're trying to see that which time you're going to trade, you have to focus on just one 4-hour candle. That's what I've done. That's what I've done for the past 5 years, 6 years, only focused on one 4-hour candle. And we've talked about this a lot of times. Whenever you have a candle moving, there are billions of dollars moving in that candle. So your job is to just scratch the surface of that candle. Hope this helps. We're going to move on to the next section. Take care. What's up, everybody? So in this section, we're going to talk about zones and ranges, right? Now, a lot of people, they confuse the difference between zones, what are ranges, how big should a range be for you to take a trade? If we're within the range, what should we do at that point? If price is at a probable zone, what's going to happen? Will that zone break or will that zone be respected? Stuff like that, right? And it's very, very important because once you see these situations happen in the charts, you start to second guess yourself. You start to think that, okay, maybe this is going to work, or if it's not going to work, or like like, you know, price has left a zone or price has left a support or resistance. Should I take a buy over here, or should I take a sell over here, or should I wait for a retest, right? So the biggest question is, if we're in a zone and you have a range in front of you, or like, you know, if you have a clean range to the left hand side, the biggest question is that, should I wait for a retest? Or should I just do an impulse entry for price to go wherever I think price is going to go, right? And a lot of people get confused in those different scenarios, right? So we're going to talk about that. And we're also going to talk about when zones are basically broken, like what times you have when zones are broken, when they're respected. So let's get to it. So first things first, let's say we have a resistance, right? And this is your regular resistance right here. Now, when you have a resistance, you have to understand that a resistance is not a specific price, right? Because when I first started in the beginning, I would look at that and I would say, okay, you know what? It's a specific price. Let's say if we're looking at pound yen, I would say, okay, you know what? This is basically, let me just do this right here. I would say, okay, my resistance is at 160, 500. Right? Ideally, it's not at 160,500 because this area you see, these are collection of prices, right? This could be between 160, let's say 160,450 to 500. It's not always 160,500. So whenever you're taking a look at charts, whenever you're trying to see where your resistance is, it's not a specific price. It's the range of prices. So that's what your resistance is right there. It's a range of prices, right? So that's your resistance. Now at the same time, let's say we have a support area down over here at this point, right? So you have your resistance, you have your support. Now, a zone, right? So this is your zones. A range is the distance between two zones. That's your range. So the distance between these two zones, let's say this is a distance of 30 pips. This is your range right over here. A range is going to tell you that whether or not you're going to have a higher probability to win a trade or not. That's what the range is going to tell you. Now, for me, if I like to take a trade, I like to have a range of about 30 pips, right? This could be, let's say, for example, if price made a high right over here, price came down, created support, and now you could say that, okay, like, you know what, maybe this range is 10 pips. If you have a 10 pip range and you want price to retest the high at this point, this is a very, very small range. It's not going to work out for you, right? So we're going to imagine that this 30 pip range doesn't exist, and we're going to say that, okay, like, you know, maybe if this is a 40 pip range, if this is a 40 pip range, this is going to be a much better idea for you to execute on a trade. Now, let's start from the very, very basics, right? So you have two zones and you have a range in the middle, okay? And for better explanation, let's say this is a 40 pip range. Ideal range. For me, an ideal range is between 30 and 40 pips. Sometimes, you know, like I can execute on a 20 pip range or a 25 pip range, but it all comes down to experience. It all comes down to how many times have you seen certain things play out in the market, right? So in this case, we're only going to take a look at a 40 pip range. Let's say your range is 40 pips. Now, for example, now let's say you have a candle and like, you know, this candle is closing bullish here in this range. Now, if a candle is closing bullish in this range and you got a 40 pip range, and if you're saying that, okay, like, you know what, the next candle has a higher probability to continue up towards our resistance zone, the best opportunity is going to be to anticipate the next candle to wick down without breaking this low and to continue pushing up. Even though this is a 40 pip range, understand this one thing. Now, I hope people are making notes. Understand this one thing. If you have a 40 pip range, it's not always that price will reach to the opposite end. It's not going to happen all the time, right? Which is why whenever you take a trade in a 40 pip range or a 30 pip range, you are securing what you can secure, like, you know, 15 pips, 20 pips, 25 pips. You can easily secure in this 40 pip range, no problem. But also note that the candle is near this zone. The closer the candle is to a zone, the better the probability that you can have a winning trade, right? What I mean by that is like if a candle leaves a zone, let's say you have a candle at this point and the candle leaves the zone, the further away a candle moves from a zone, the higher the probability that it may come down to do a retest. Now, there's one thing that I've seen traders do all the time, whether you're coming from YouTube or you're already in market fluidity. I've seen this thing, where people do this all the time. You're going to have a candle closing away from a zone. Let's say that this zone here doesn't exist. Let's say we have clean candles to the left-hand side, and we've moved further away from the zone in a manner that a candle closed like this, right? Well, now what guys are going to say is that, okay, since we have volume at this time, we're going to anticipate the next candle to wick down, break this high, and then continue to push up. Now, on paper and theory, this looks good, right? This looks good, but the probability of price moving further up, it becomes lower than the probability of price retracing to create support, unless you have a lot of volume, right? Unless you're running at pre-London, you're running at London Open, unless you got a lot of volume, it's going to be a very low chance that price will continue to push up. Most probably what's going to happen is that price may move up and then it may continue on pushing down. This has happened to a lot of people in the past as well. Price may do something like this, like moves up, breaks the high, comes back down and closes a bearish candle like this, and now you're left holding the ball on the losing side, right? So whenever you have a candle that's breaking outside of a zone, and it's I would say maybe if it's 15, 20 pips away from a zone, there's a high probability it's going to do a retest. I'm not going to execute on that candle. I may execute when price comes down to do a retest. So ideally, what I would want to see is that whenever you have a candle that's breaking above a zone, it needs to be closer to the zone, right here, okay? Because, listen, the closer the candle is to the zone, the higher the probability it's going to leave that zone, especially if that's a 30-minute time frame, 15-minute, depends on the situation, depends on the amount of volume. 1 hour time frame, 30-minute time frame, they're awesome. If you have a candle that's closing at a zone, like a 30-minute zone or a 1 hour zone, it has a higher probability to leave that zone, or it has a higher probability to reject that zone. For example, let's say we move back to our resistance at this point, right? And this is your 40 pip range, and if price comes up, your price is at at a resistance at this point, and we're basically creating a resistance right over here. If we're creating a resistance right over here, and this is a 1 hour zone or a 30-minute zone, then there's a higher probability it may continue to push down. There's a high probability. Now, I'm not going to say that this is valid in a range. Even if you have a range, you have to take this trade when there's volume in the market, like pre-London, London Open. And this range also has to be like a 40 pip range, like a 35 to 40 pip range. Sometimes we can have a 30 to 40 pip range, but price is just not really moving. Candles are not that big enough. Sometimes you can have, a 25 pip range. If you have a 25 pip range, and you're taking a sell right here, what are you trying to get? If this is a 25 pip range, let's say an average spread is 1.5 pips to 2 pips. Now you're left with a 23 pip range. 23 pip range. What are you trying to get? 10 pips out of it? No, man, nothing. It's not going to work like that. Now, another thing that I see people do all the time is that, okay, so let's remove this area here, right? Let's remove this, and let's remove this, and let's do something like this. You got a support area, you got a bearish candle closing right here, you got a wick. Okay, the reason why don't take a sell within the range when a candle is in the middle of a range is because when a candle is in the middle of a range, there's a 50-50 chance. There's a 50-50 chance whether the candle is going to go up or it's going to go down. There's a 50-50 chance because now we're in the middle of a range. And even if this is, let's say, a let's say it's a 45 pip range, right? If we're in the middle of a range, even though you can say, okay, you know what, hey man, we got a 20 pip range to move to the downside, 20, it's still in the middle of a range. You have to look at probabilities, right? Probabilities. Probability dictates that there's a 50-50 chance that the next candle may move up or it may move down. There's a 50-50 chance. So we only have to execute when the probability is in our favor, right? Let's say we are right over here. We are right over here. Right? It's closer to a zone right here. The closer price is to a zone, or the closer candle is to a zone, there's a higher probability for price to reject that zone, or for price to leave that zone, right? So now, whenever we're going to talk about sells after resistances, we're talking about sells after resistances in downtrends. Whenever we're going to talk about buys at supports, we're only going to talk about buys at supports in uptrends. Perfect. Hopefully we're all making notes, right? So, this is the basics. You got your zones and you got your ranges. Whenever you're trying to take a trade, you have to make sure you have a big range, like a 30 pip range, 40 pip range. You know, on gold, you can easily get a 40 pip range. These days, there's a lot of volume in pound yen. You can get an easy 40 pip range, 30 pip range. As you go down ranges, like let's say as you go down towards, you know, like a 25 pip range, for you to get that trade or for you to get that move gets a little bit harder, you know, because then you're anticipating the candle to move like 10 pips, 15 pips, you know, 20 pips if you're lucky. So that's what happens right there. So whenever you're taking a look at your ranges, first thing first, you need to see how much of a range do you have. If you have a 40 pip range or a 30 pip range, you're like, okay, perfect. You know, I got a 30 pip range and I can execute a trade in that range. Okay, awesome. Second is, where is the candle closing? Where are you taking an entry? Are you taking an entry near a zone? Right? Are you taking an entry near a zone? Or are you taking the entry once price has left the zone? If you're taking an entry when price has left the zone, the chances of you winning the trade is 50-50. And we're not in this business to make money on a 50-50 chance. We're in this business to make money where the probabilities is in our favor, right? So always you have to make sure that you're trying to execute when price is near a zone. Near a zone, because then when there's volume can push price down, or from here volume can push price up if we're near a zone at this point. Right, now zones and ranges, they may seem simple, but when price is moving, you know, FOMO gets in the way, over trading gets in the way, revenge trading gets in the way. We really need to understand, we really need to control that. You know, those feelings are really going to fuck you over in the markets. Okay, so you have to understand, whenever you're taking a look at the charts, you have to measure how much range do you have. Is it even a tradable range, right? If you're looking at a tradable range, do you even have clean traffic to the left hand side? It's very important to have clean area to the left hand side where price has moved easily to the left hand side in the past, and now you can expect price to move there easily as well. So again, I'm going to reiterate everything, right? First things first, you need to know where your zones are. Once you have your zones, you need to understand how much range do you have between those zones. If price is going to break resistance, do you even have enough range for price to move in? Because if you have enough range for price to move in, that means you can grab a part of that move. Not the whole move, the part of that move. If you want to grab the whole move, then you're maybe, you know, you're letting a runner run. You're letting like, you know, 10% run, 20% run, 15% run, whatever that number is. You're letting those runners run, but initially you're securing what you can secure in that range. Right now, study this, make it a habit. Whenever you're trying to analyze charts, make it a habit to plot out your zones and then measure the range. Is there enough range? And for the first few months, just sit and watch. Sit and watch to see how price moves between those zones. Thank you.